The Augusta Rule, is this a great tax strategy, a wonderful loophole in the tax law, or is this a disallowed deduction? We get this question a lot, and the answer is very simple. Well, it depends. So let's look at the purpose of the Augusta Rule was, and then we'll look at a recent court case. This was in August of 2023 that shed some light on this subject. And I feel like if you look at that court case, you'll feel very confident in your ability to take this deduction. So what is the Augusta strategy? This is a rule in Code Section 280 of the Internal Revenue Code that allows individual homeowners in any tax bracket to deduct rental expense on their personal home for up to 14 days. And they will get a 1099 rental from the business, but that income is excluded tax-free from their personal income tax return. But it's also deductible by the corporation, and that's where the debate lies. There are several instances where this may be beneficial. So if you're a business owner and you need to hold business meetings, or you're doing business training and you need to use your personal home to do that, maybe you're having the employees come and do a training session, maybe you're having board meetings, you are able to deduct a fair market value for renting that home from your business. And then that can be excluded from your personal income as long as that rental is 14 days or less. So if you do it 14 times a year, that's a business expense. It is not considered taxable income to you as an individual. So it works great if you need to rent your individual home from your business. Maybe you have a vacation home and you don't want to be a full short-term rental business, but you want to rent that home out for 14 days or less every year. You don't need to keep up with your deductions. That rental income is not taxable as long as it's 14 days or less. So the Augusta Rule originally came about because the Masters Golf Tournament in Augusta, Georgia, every year people went to that tournament. They had no place to stay. So individual homeowners began renting out their homes for up to 14 days. And the IRS said it's a de minimis rental income. It's not really worth the trouble. You guys can exclude that income on your personal tax return. You don't need to report that as rental income. And that's how this rule came about. And of course, businesses have found additional ways and circumstances to apply that rule. The qualifications for the Augusta Rule. There's a great court case. It just came out in August of 2023. Sinopoli versus Commissioner. And that gives you a great insight into what is and is not allowable, and what the IRS is going to look at if you take this deduction. Make sure that your dwelling is your own personal residence, that you own the home. So you can't use this if you're renting your home. You need to own the home. It will include it if you own a second home or a vacation home. Those can be used as well. The rental needs to be 14 days or less, not 15 days, but 14 days or less. The 14 days does not have to be consecutive. So you could rent 14 times. You could rent once a month. So it needs to be an arm's length transaction. It needs to be what it would cost you as a business to rent space in order to hold this training session or this board meeting. So make sure that the rental price is reasonable. Obviously, the expenses related to this rental property, your personal residence, are not deductible. You're not including that income as rental income, so of course there are no rental expenses. So let's look at the court case and what we can take away from reviewing the facts of that case. So the case is Sinopoli versus Commissioner, and there are three main takeaways from this. The first one is ordinary and necessary. The second one is arm's length transaction, and the third one is proper documentation. These are all common throughout the tax code. This particular case, the defendants really failed in all three of these areas. Ordinary and necessary just means it needs to be a legitimate business expense that is common and accepted in the industry. It needs to be helpful and appropriate for the trade or business. And as always, the burden of proof is on the taxpayers. So make sure if you're doing a business meeting, there's a legitimate business purpose. You know, you need to meet with your board or you need to do this training session. That's ordinary in your business. So ordinary and necessary. The second one is arm's length transaction. And this was the big sticking point in the case. They charge too much for the rental. Rental is fair market value, what it would cost you to rent space to hold your meeting. I think the most conservative way of doing that, if you're renting your home to do a training session, what would it cost you to rent a short-term rental on Airbnb? Get your documentation for that, take a screenshot, and let that documentation be contemporaneous. Don't wait until you get audited and then try to go back and figure out what fair market value was. And so make sure you're pricing that rent at fair market value. And then the final point is proper documentation. This goes for everything that you deduct on your tax return, but specifically, most importantly, when you have a related party transaction like the Augusta Rule. So proper documentation. If I'm having a board meeting, I need to have an agenda. I need to have minutes for that board meeting. Maybe I sent out an email to my board members. I documented the date that was sent out. I kept a copy of that email. This needs to be contemporaneous at the time that the meeting took place, not 3 years later when you're being audited. So make sure you have that proper documentation. Take your meeting minutes. Invoice your business for the rental. So it needs to be treated arm's length transaction just like you would treat anything else. So you need to send your business an invoice, and your business actually needs to pay you for the rental just like you would with any other organization. Your business needs to send you a 1099 for that rental income. It won't be taxable to you, but it does go on your tax return, and it needs to be non-taxable income on your tax return. And then just make sure you're keeping a clean paper trail and that your CPA is aware of that. So I always like, if somebody is going to use this method, for them just to send me that documentation as they prepare it. And that just keeps a good record of this was done at this time, and all the documents are in order. In the Sinopoli versus Commissioner, I feel like if they had the proper documentation and they had charged a reasonable price, there would have been no problem. That deduction would have been allowed in full instead of only a partial deduction. Okay, so that's it for the Augusta Rule. I hope that clarifies for you. In my opinion, it's a great tax strategy in certain circumstances, so consult with your tax advisor. If you found this content helpful, be sure and like and subscribe, and we'll see you next time.